The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Big tech earnings deliver while non-tech earnings wither. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
I'm Alex Steele. He rhymes, and also the S&P is now up for 8 straight days. We haven't seen that streak since last August. Now here it does seem, though, that those tech earnings are trumping any kind of weakness in the macroeconomic data like we got from the ISM manufacturing. S&P up over 1%. We were right around, at one point, the areas where we were on that Liberation Day. So we've almost recouped all of those losses. NASDAQ really outperforming as the Mag 7 is up the most since the beginning of April 9th, I should point out, the rally day. Two-year yield down 9 basis points. Remember, we don't really know why that is necessarily, but nonetheless, you're seeing some positioning change there in the bond market.
Yeah, we go back to the equity market, and it really is about big tech. Strong cloud growth at Microsoft last night, strong AI commitment out of Meta, really propelling those stocks in the broader tech space higher. You had reports of a potential easing of restrictions on some of NVIDIA's overseas sales. That's adding some fuel to what is now, as Alex said, an 8-day rally for the S&P 500. Now, the earnings last night, that's giving some hope for the next big batch coming out tonight, which includes Apple and Amazon at the top of the food chain. You have Roku, Strategy, Atlassian as some of the names a bit further down the ladder, all consequential, because so far, half of the tech companies in the S&P had reported earnings coming into today. 90% of them beat EPS estimates, 60% beat on revenue, and a big part of that is why we saw the rally over the last few days and weeks. But of course, the flip side to tech's relative strength is the macro-induced weakness for the consumer discretionary sector. For that group, which includes Tesla as well as Home Depot and Airbnb, barely half have beat on EPS and only 20% have beat on revenue. In fact, McDonald's today saying its customers still grappling with economic anxieties. Its same-store sales down almost 4%. GM cutting its full-year profit outlook because of the auto tariffs. And Harley Davidson, I know you're a big fan, Alex Steele, pulling its guidance all together.
I mean, take a look at that. Miss my hog, I got to say. All right. So from all what Romaine said, you think there'd be a micro up trade, right? Earnings really matter. Stocks move on earnings. However, the correlation is really picking up within the S&P. This is a great chart that comes to us from Natalia Knežević over at Bloomberg News that shows the correlation between stock indexes is at 0.6. Now, we haven't seen this during this time in an earnings season for a very long time. You'd have to go back all the way to 2011 to see this kind of correlation during this earnings season time. That means that stocks are moving together, not individually, Romaine, which still begs the question. It's still the macro trade that is moving the index.
Absolutely. We kick things off to the close here on this Thursday afternoon with Maria Vassalou, head of the Pictet Research Institute, joining us live here in Studio 2. Great to see you.
Great to be here.
We talk about a market that, at least this time of year, is supposed to be driven much more by corporate earnings, the micro, as Alex was alluding to. But this is still a market, 100%. Is still hanging on every word when it comes to policies out of our governments and, of course, the economic read-through. What is that economic read-through right now? Do you have any sort of sense of where we're going?
Well, we are moving from one equilibrium to another. We have been going through a protracted period since the end of the Cold War of globalization, unfettered free trade, and world peace. And now all these things are being challenged. We are at a pivotal time. So obviously there is a lot of policy uncertainty. There is a lot of regulatory uncertainty, trade uncertainty, and fragmentation that actually are going to reset the whole way the world financial system is functions.
When we talk about that reset, is this going to be sort of a fundamental breakdown and dismantling of globalization? Yes.
Well, you know, what has been going on is that for a long period of time, the rest of the world was shipping their surpluses to the U.S. and in exchange, the U.S. will provide U.S. dollars, U.S. treasuries, and equity returns. And the rest of the world has been holding about 40% of U.S. Treasuries and 40% of U.S. equities. And this arrangement was working so long as the U.S. was the leader in technology and its debt level was not exploding. Now we are in a situation where the U.S. is being challenged in its leadership of technology. And if it doesn't maintain that, then the whole arrangement is breaking down. So globalization, free trade, and world peace does not really work to the benefit of the U.S. if it loses its technological advantage, because then it becomes like any other country whose currency was the reference currency in the past, and it didn't manage to maintain it.
Look what happened to Germany and then the UK, etc. Though I know this is a short-term view, but we're still learning that the technology companies can deliver, and they can deliver it profitably, and they can continue to spend. Does that give you reassurance?
Well, it's good that we're seeing that, but we should not become complacent. China is making huge strides in its abilities to advance in technology. So far, most of the advantages are in speed rather than in new applications, but that's going to come over time. So it is very important. It should be a national policy to promote technology research and innovation, so that the U.S. equity markets can continue to maintain their dynamism.
So that feels like a very binary situation that could unfold. What's the right allocation in something like that?
We are now in a period of rebalancing from one set of principles under which we were constructing portfolio into a new paradigm. And this new paradigm will be significantly different. So, for instance, the concept of developed markets versus emerging markets is getting blurred, because the characteristics that we were considering as important for developed markets, stability of regulations, no political risk, no uncertainty of policies, and so on, are no longer in place.
Yeah.
At the other hand, technology is something where you see it in a country like China, which is still considered an emerging market.
Right, which probably shouldn't be. I mean, I know on a per capita basis, that's why it's there. But on the technology side, because this is sort of a key component of American exceptionalism over the last few decades, was that when you were looking for growth companies, you were obviously going to look for innovative companies, and the U.S. had been the breeding ground for that for decades. There's no one making a case right now that I've heard, let's take China out of the equation, that you have other countries that can maybe replicate what the U.S. did over the last few decades. Is there a switch that might occur where we might see Europe or the UK or maybe some nation from the global south sort of rise up and fill that role? Or is the US at some point going to maybe reassert itself as being that technological leader?
I think the challenge for the U.S. is China. It's not necessarily Europe or some other country. There are particular innovations that appear in Europe. The problem with Europe is that it doesn't have unified capital markets. So usually the idea may be born there, it goes through proof of concept, and then it comes to the U.S. to be funded and developed. So we still have this advantage in terms of our capital markets, our availability of capital, the framework within which businesses operate. But in terms of pure technology innovation, the main challenge is China. And that's why you see the foreign policy, all the economic policy really being targeted towards China.
It's being targeted in a way to slow them, but is it being done in a way that actually builds up the U.S., meaning does it further our own ambitions here rather than just blocking China's?
Well, it's a competition, so I think in the short term the effort is to also slow down China in order for the U.S. to gain time. So that's part of the thinking, I believe.
All right, Maria, great conversation, and of course, a lot to chew on over the next few years and decades, if you will. Maria Vassalou, head of the Pictet Research Institute, kicking us off to the close here on this Thursday afternoon. When we come back, a focus on travel with the CEO of Host Hotels and Resorts on the heels of their most recent earnings report. We're going to talk about how they were actually able to increase, believe it or not, Alex Steele, their guidance amid all the macro uncertainty.
All right, staying on the topic of outlooks, we're going to look ahead to what's next for the energy sector as data center demand ramps up. Xcel CEO Bob Frenzel will be joining us.
And of course, the talk of the town right now is that bonkers Wall Street Journal story that came out overnight that the board of Tesla was actually looking for a change in leadership. We're going to talk to Ross Gerber, a longtime investor in Tesla, to get his thoughts here on maybe potential changes at the top of the C-suite there over at Tesla. This is The Close on Bloomberg.
Watching shares of Host Hotels and Resorts up by over 3%. The hotel REIT is boosting its guidance for the full year. Joining us now to discuss the current economic environment and how that impacts the hotel REIT industry is CEO Jim Risoleo. Jim, how are you guys doing so well considering all we hear is concerns? The soft data comes in really weak. CEO confidence is really weak. Why the strength in your business?
Sure. Alex and Romaine, thanks for having me today. We really appreciate the opportunity to talk to you. This is really, for Host Hotels and Resorts, this is the culmination of a capital allocation strategy that has been going on for about the last 8 years or so. We completely transformed our portfolio. We disposed of $5 billion of assets at a 17.3 times EBITDA multiple. We acquired $4.9 billion of assets at 13.6 times, some of the best resorts and some of the best city center hotels in the country. And we've invested in our properties. And it's really starting to show in our results. We were delighted with our quarter. We had 7% RevPAR growth. Yeah. We had 5% growth in F&B revenues per available room. And we had a $25 million beat, which we passed through for the year. So
Jim.
Yes,
Jim,
Alex.
That's a lot of the work that you guys have done in order to right-size the business and get to the right place. But now there's this macro uncertainty on top of that. What's your visibility like?
We have pretty good visibility, actually. You know, the first quarter was very good for us. And we can look out into future bookings, group bookings in particular, give us the greatest degree of visibility over the course of 2025. And the group customer is healthy. Our leisure customer is very healthy. We cater to the affluent customer in the United States, and they continue to prioritize experiences over goods and services. And, you know, our belief is that last thing that's going to go is their vacation. As one example, in the first quarter, we own the Four Seasons in Jackson Hole. We picked up 15 percentage points in demand in room nights, and we ran the property at a $2,800 ADR. And that is just an incredible statistic. And we've seen that throughout our resort portfolio and at many of our other properties as well.
I am curious, Jim, with regard to your geographic mix, I mean, you're pretty well spread out, but you do have a high concentration of properties, or at least if you go by number of rooms, certainly in Florida and obviously in California. Are there any sort of regional differences that you're seeing in terms of bookings, and not just bookings, but also just the amount of spend that you get out of those customers when they do arrive at the resort?
Well, you know, if you look at our results for the first quarter, you will discern that we had strong growth throughout all of our assets. We have no concentration greater than 8% of rooms in any one market. We have a very well-diversified customer base as well, with a mix between group, business transient, and leisure transient. And a number of the markets performed very well in the first quarter. So it's not, you know, you can't just take one brush and paint everything. You have to look at market by market. We have revenue management strategies for each hotel. Dynamic pricing is in place as well. So we do everything possible to drive the top line, because that money is going to flow to the bottom line and benefit our shareholders.
How much of your business is business, meaning how much of it is business travel, Jim?
Well, the breakdown for Host is about 30% group, 5% transient, and 5% contract and 60% transient. Of that 60% transient, roughly 60% of that is business travel, and that equates to 36% of our total revenues.
Are you also looking, Jim, at this opportunity? Is there more that you can sort of add to your portfolio in this uncertain time?
Well, you know, we had a terrific year last year. We deployed $1.5 billion of capital, entered 2 new markets, Nashville with the acquisition of the 1 Hotel Embassy Suites, and the North Shore of Oahu, where we purchased Turtle Bay Resort and converted that to a Ritz-Carlton, as well as we purchased the 1 Hotel Central Park at 58th and 6th. So we've been very active on capital deployment. We'll see what the year brings us. You know, the great thing about Host is that we are positioned in a way that we can allocate capital along a lot of different buckets at the same time. We're the only investment grade lodging REIT. We sit at 2.8 times leverage at the end of the first quarter. We have $2.2 billion of liquidity, and that's comprised of a $1.5 billion credit line that is completely available to us, plus cash and FF&E reserves. So if opportunities present themselves, of course, we will pursue them. It's a long-term business, and we like to invest for the long term.
All right. Well, investors seem to be embracing that as well. The stock right now on a 4-day run on the heels of those earnings. Jim, we'll catch up with you next quarter again soon, I'm sure. Jim Risoleo is the president and CEO of Host Hotels and Resorts. When we come back, we're going to, talk a little bit about Apple. Alex Steele, you got something to say about Apple?
No.
Oh, I thought you had raised your hand.
Me? No, I was typing.
Oh, okay.
But I was totally focused on what you were saying, too.
Okay, all right. We're going to talk to Laura Martin, Senior Entertainment and Internet Analyst over at Needham Co. Stick with us. This is The Close on Bloomberg. All right, let's get to top calls. Big movers on the back of analyst recommendations. We start off with Burberry. The luxury apparel maker upgraded to a buy after a 17-year-long neutral rating on the stock over at Citi. The analyst there seeing significant transformation potential over the next 3 years and expects the new CEO's Burberry forward strategy to start paying off. The shares higher on the day. You're looking at the London shares up 1.6% on the day. Next up, Trivago, the travel company. B. Riley upgrading to buy and raising the price target to $5.50 from $4. The analyst cites the company's turnaround story on earnings and sees robust growth and profitability ahead. Those shares having a phenomenal day, up 27%. And finally, Qualcomm, benchmark, trimming its price target to $200 from $240. The analyst citing multiple compression throughout the chip and tech sector that is likely to continue. Though, for the quarter just passed, he does say Qualcomm undoubtedly benefited, at least marginally, from Apple pull-ins in its handset business. Those shares, though, down 8% on the day, and those are some of our top calls, which leads us right into, the granddaddy of them all. Apple set to report earnings after the bell tonight. Investors closely watching these results for any hint as to what's going on in the broader consumer space. Laura Martin joins us right now, Senior Entertainment and Internet Analyst over at Needham & Company. Hello. She's got a buy rating on the stock. Laura, a lot of expectations on this. Every quarter there's high expectations. But I am curious, given all that's transpired with the tariffs and concerns about Apple's relationship with China, what are you expecting to hear tonight?
So I think there are a couple of really big issues, some of which got added to today. But the most important thing is we're estimating Apple will grow revenue at 4%. But last year, China sales of iPhones were 17% of total. So anything that makes it look like geopolitics and the rise of nationalism in China are forcing Apple to lose share of iPhone sales in China would basically imply they're going to go to negative revenue growth as those China sales go from 17% to towards 10%. So that'd be really bad for the stock if that's what we're hearing, either because of tariffs or just because China's mad at America, so consumers are buying Chinese handsets upon replacement. So that's the first thing. Second thing is they just lost this big lawsuit about the App Store, right? And actually the court is actually going to sue an individual at Apple for lying under oath about this, being able to pay for apps outside the App Store. So that's actually a really big deal. Why? Because we have services growing 12% in the quarter and at a 75% margin, whereas we have iPhones, or let me call it device sales, growing 1% at a 35% margin. So it's really important that services remain intact. if China is going to be a risk factor for the next 2 years.
What are you looking for from the U.S. side of the business, particularly going forward, and the idea that some of those phones that they might try to sell later in this year might have to account for tariffs?
Right. So one of the things that we saw that I thought was fascinating is when Jeff Bezos, and of course that's not who runs Amazon, but when Amazon was going to label the tariff fee to show why prices are going up, Donald Trump picked up the phone and called Jeff Bezos and said, do not do this. Same thing with Apple. Like, the administration's not going to let Apple say, hey, our old price was $1,100 on this unit, tariff adds $300. They're not going to let them break it out. So what that means is, assuming supply and demand, like Economics 101 holds, you should see demand fall for iPhones, or you should see Apple subsidize iPhones, so their margins will be under pressure. So those are the two outcomes of tariffs if they aren't allowed to break out tariffs as part of the price point, so consumers can put the blame squarely on tariff policy coming out of DC.
You think Apple would eat the cost? It wouldn't go to like the telecom providers like a Verizon?
Yeah, I do. I think that they have a choice. They either eat, and maybe they split it 50-50, but that is Apple's choice. Do they want to sell as many units, but they have to take a lower margin because their margins at 35% on devices is pretty freaking high. Or they have to raise the price pass through the full tariff, and now you're going to have fewer units. They have to decide what's the better. My opinion is they should eat the tariffs, lower their margins, because installed base is the only thing that gives you the option to earn services revenue at a 70% margin.
Well, that's what I was going to say. I mean, I feel like 6 months ago, the only thing we were talking about was services and how fast they can grow their services revenue. How good is it? We haven't even touched on that at this point.
Right. Other than to say the litigation really puts that at risk, those margins at risk.
Right. So what kind of growth might we see in that area?
So we're saying 12% in the quarter. And then hopefully, I mean, I think one of the things that Wall Street's really frustrated by is last quarter, every CEO other than Apple talked about Gen AI. Today, we want to hear, are they talking about Gen AI? Are they talking about the litigation and are they talking about China sales? Are they going to pretend like none of this is happening, which makes you feel like the management here is out of touch? So that's a big thing we're listening for, is the silence on all the big issues that Wall Street cares about.
All right. Good stuff. Really looking forward to it. Laura, feisty as ever. Laura Martin, senior entertainment and internet analyst over at Needham Company. I just think it's going to be a lot of fireworks on the call, Romain.
It's going to be a lot of fireworks on the call, particularly, I mean, when you consider what their most recent quarter is going to look like, which is lagging the broader S&P 500, and we're going to assume guidance probably also might potentially lag. What's the explanation that they're going to give beyond just think times are tough?
I know. And the tariffs, and then also, did you start talking about moving production in different places? Does that come up in terms of maybe going to India in a more meaningful way? All right, coming up, we're going to stay in the tech world, kind of. We're going to speak to Bob Frenzel. He's the CEO of Xcel Energy, one of the country's largest public utility companies. What's the data center demand on these utilities? This is The Close on Bloomberg.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romain Bostic.
I'm Alex Steele. We talk about tech really getting a boost today. You know what's also getting a boost? Oil prices, which is impressive because it was a terrible month for oil last month.
Yeah, it was like something like 18% slide in WTI.
Brutal.
I don't know what that was about, if that was macro, if that was OPEC plus, or that was somehow... Yes
to both of those. Yes, it is. Right. Yeah. And what we're seeing actually is President Trump threatening secondary sanctions on buyers of Iranian oil, and that moving oil higher. So when you have big oil like Chevron and Exxon reporting tomorrow, okay, maybe we can get back into a different trading range.
Yeah, and it's kind of interesting too. I mean, we talk about obviously how commodities sort of fold into the broader financial market picture that we've been talking about. And it's kind of been bifurcated. I mean, you have some pockets that have done well and others that are still struggling.
You know what's done really well? Those utility companies that may have exposure to data center demand. Speaking of, yesterday we spoke to the CEO of Edison International about their ability to meet data center demand despite the impact from the Eaton wildfire in California. Here's part of what he had to say.
Eaton is not into that. We absolutely can continue. Today, we're investing, or over the next few years, we're in the range of $6 to $8 billion a year of capital investment, pending a general rate case decision. And so, again, one of the benefits of the wildfire framework we have here is that because we can access the wildfire fund, An exposure like that should not impact our metrics, and we can continue to make the investments that our customers need us to make.
Well, joining us for another perspective is Bob Frenzel, the CEO of Xcel Energy, one of the largest utility companies in the country. There we go, providing electric and natural gas services all throughout the U.S. Thank you for joining us. We really appreciate it.
Thanks, Alex. Thanks, Romaine. And I appreciate it. Talking about energy and talking about serving customers is one of my favorite topics.
Okay, so our data center's calling you and saying, I need power, I need it today. Here's what I'm going to do for you.
Absolutely.
Who's calling you and what do they want?
Everybody's calling us. You know, if you step back and think about Xcel Energy, we are headquartered in the Twin Cities, but we serve 8 states across the Midwest, in the Southwest, into Colorado, and into Texas, and into Mexico. And as you can imagine, with that footprint, we have incredible access to wind resources, solar resources, and the ability to power data centers with, you know, carbon-free energy. And you pair that with our nuclear fleet and our gas fleet, we have an all-the-above energy strategy that allows us to meet the needs of our customers.
Do you feel that data center demand will drive expansion of existing energy or create opportunities for new forms of energy? SMRs, small modular reactors of nuclear, large nuclear plants, for example, geothermal, et cetera.
Yeah, look, I think that we have the opportunity with our existing fleet to serve a certain amount of existing generation. We have about a 9,000 megawatt backlog of data center demand through the end of the decade. And we think we can meet a piece of that with our existing fleet and our existing grid, but it is going to take infrastructure investment to meet the needs of all of that, if all of that were to come to our territory. What we do know, though, is these data center developers and hyperscalers are knocking on my company's doors and everybody's company's doors looking for energy sooner rather than later. So I think we'll be able to meet the needs of the data centers as they ramp up into their demand. And I think it is going to be a bridge to future generation technologies. What we have available today in the country, wind, solar, and storage, ready to go. Yeah. We'll need gas plants as insurance products to back those up. And then as we get into the next decade, I think you're going to see new forms of generation come that are carbon-free, that are dispatchable, geothermal, new nuclear, carbon capture and sequestration.
Who's going to bear the cost of a lot of that infrastructure investment? I mean, how is that going to be shared?
As an industry, we have a long history of sort of cost causation and cost allocation. And the way we serve our customers, we have residential customers, we have small business customers, and we have large industrial customers. And we like to think about allocating the needs of the system by who causes the demand. And so when you think about the hyperscalers, we've been particularly focused on protecting the existing customer base while we're able to serve this new customer class.
Is the regulatory structure, though, at the state and local level, can you sort of have a materially different charge for a hyperscaler that is going to be more taxing on the system relative to somebody like me who's just flipping the lights on and off?
Absolutely. We already have different tariff structures and contract structures for large industrial customers who are big, heavy users versus residential customers like yourself. And that will persist into the future as we think about serving these new customers. And companies like mine have taken 2 different paths. I don't think either one are necessarily right or wrong. You can either create a new tariff and allow them to tap into that tariff, or you can go into one-off contracting structures, which we have done as a company. We call them energy services agreements, and they're contracts with hyperscalers that have minimum volumes, minimum prices, durations, and other protections for the existing customer base.
You mentioned earlier that you see data centers wind up helping to spur new forms of energy. You said nuclear. You didn't say SMRs. You didn't say small modular reactors. Are we talking like a big nuclear plant can be built in the U.S. from hyperscaler demand?
I'm a former Navy nuclear officer. I like to think I ran the very first SMRs in the country. I think we talk about them as advanced nuclear, but yes, small modular reactors absolutely have a place in our country's energy future. I do think, though, because of these large loads that the data centers want, I think you're going to see people contemplate whether they build a large-scale nuclear reactor again in this country.
Can that happen?
Yes, we have the AP1000 as a technology that's licensed and ready to build. We've built 2 of those units down in Georgia as an industry, and we learned a lot of lessons from those. And I think if we were to move forward and if companies were to move forward to build another AP1000 type technology, I think they would probably approach it slightly differently, incorporating the lessons learned from the first 2 units that were built.
I mean, as you kind of sort of chart out this sort of long-term planning for what energy demand is going to be, how much faith can you put into this idea that it will be relatively consistent? And this is more about on the business side with AI and the data centers, because we've already seen some ebbs and flows as how these companies are communicating what they're going to build and more importantly, how much they're going to spend.
We talk a lot about the need for speed and making sure that we can meet this moment. As I think about AI, we're really excited about the business opportunities that AI brings, both from the technological side and what we can incorporate into our own business, but serving new customers and how those new customers can help the existing ecosystem become more affordable for everybody. I think that the technology is accelerating to serve them, and I think that our ability to meet the moment is real.
With regards to just the interconnectivity of our electric grid, or lack thereof, I should say, are you hearing more concrete discussions about maybe how to address that long term, particularly as energy needs continue to increase? There's been a lot of discussion about this idea of transferability and portability across jurisdictions.
I think that we have a terrific energy grid in the United States today. I think we need investment into the grid for a host of reasons: cyber protections, weather protections, customer expansions. And so the idea to rethink how the grid works today and how we can make it more interconnected across the country is certainly topical. And you're seeing a lot of the regional transmission organizations, we're members of MISO and the Southwestern Power Pool, talk about how do they become more interconnected? How do we build transmission faster and maybe in advance of the load so that we can encourage economic development, which we know is good for our states and for our communities.
All right, Bob, really appreciate you being here today.
Thanks, everybody. Appreciate you guys.
Bob Frenzel, CEO of Xcel Energy. As we continue to count you down to those closing bells, and speaking of energy, let's kind of stay in that space, but with a focus on EVs and specifically Tesla. The EV maker's chair, Robin Denholm, denying a report that came out overnight from the Wall Street Journal that Tesla's board was looking for a new CEO to replace Elon Musk. A statement she issued backed Musk, saying that the board is, quote, highly confident in his abilities. Joining us right now is Ross Gerber. He's the co-founder, president, and CEO of Gerber Kawasaki Wealth and Investment Management, and it's been a long time Tesla shareholder. All right, Ross, as soon as I saw this headline cross the wire yesterday, I immediately thought of you. There's been a lot of people that look at this company, look at the brand, and they see the damage that's been done, and a lot of people link that damage almost solely to the extracurricular activities of its CEO. I know the board is denying this, but there is additional reporting, including from Bloomberg, Reuters, and other sources, that there was indeed some degree of search, maybe not an official search, but certainly there were folks on that board that were seriously considering a replacement for Elon Musk.
Yeah, and I think that this is true, but I think within the context that the idea that the board is doing this without Elon's knowledge, I think is probably incorrect. In fact, I would argue that most likely Elon is behind this search because his real focus and passion is with XAI, and he really doesn't, he understands he needs to put his focus on AI if he wants to become the king of AI, and that's not going to happen if he's spending a lot of time at Tesla. So it doesn't surprise me at all to hear this news, but I think the idea that this is somehow happening without his knowledge or behind his back is probably incorrect.
Well, one thing that I'm interested in, too, that if there is, and this is obviously, we're still in hypothetical territories here, but if there was a change in leadership at the top, there had been some speculation that his focus on XAI, that somehow this would all be integrated with Tesla in some degree or another, and some of his other properties. The idea that you would be buying almost a whole ecosystem of Musk properties, to be sure. Does it matter that maybe potentially Tesla might not be part of that?
Right, and that's exactly correct, because what he wants is not to be a part of a public company in building his next venture, and that's what he's done with X and XAI, merging them together into this, sort of $100 billion AI, multi-company behemoth of what it is, and that's, why I think if you also think about the potential growth of XAI versus Tesla, it just, XAI could grow 10x, where Tesla has really seen a lot of its growth behind it. So yeah, I think if he's really going to build a great AI company, that's where he's going to have to focus. And unfortunately, that's at Tesla's cost. But I don't see him bringing Tesla into this mix because it's a public company that he doesn't really control.
So Ross, based on that, who would you want then to lead Tesla?
Well, right now, originally I wanted Elon Musk to just lead Tesla, but now that's obviously not happening. And so the only person I can think of who's even qualified to do this, who Elon could work with, is JB Straubel, who's on the board of directors currently, who has obviously dealt with investors and institutional shareholders, has built a successful company in his own right, and was a co-founder of Tesla, and certainly is a friend of Elon. It's whether or not JB wants to have that relationship with Elon again that becomes, really tough. And there might be a high likelihood he doesn't want to do that. So I don't think it'll be easy for them to find an outside person to run Tesla unless Elon obviously approves of that person. So that's what I said. I don't think anything's happening without Elon's, thumb on the pulse here. And so it's really about Elon trying to find somebody to replace him so that he can focus on XAI and he can find another Linda Yaccarino type, then they'll be in good shape.
So, Ross, if we take a look at what Tesla's trading at, we're still looking at an estimated PE at 133 times. Would Tesla without Musk, what should that PE be?
Well, that's, I think, the consternation people are feeling is that if Musk steps away from Tesla and Tesla is revalued, even like a regular tech stock at, let's say, 30 or 40 times earnings, there would be a substantial decline in the stock price, which could happen with or without Elon, to be honest. I think they're going to work very hard to create the perception that nothing's really changing at Tesla, because that's actually true, because Elon doesn't really work there now very often. And so it's like, so that's what I think is that Robin Delholm will resign as chairman of the board, Elon will become chairman of the board, and they will make an enormous effort to show and prove to people that things aren't really going to change at Tesla. It's just about getting more help, and Elon's still going to be doing what he's doing. And if they can convince investors of that, then I think this is a net positive for Tesla. I don't think Elon's going anywhere for Tesla, but I do think Tesla needs somebody working there full time and somebody that can change the optics around the company so that consumers will go back and buy their products.
Well, that's what I'm curious about. I mean, given the damage that's been done, do you think that is actually feasible, that they can sort of repair the brand image amongst, and let's face it, amongst a base of people that, quite frankly, were kind of like the core people that kind of helped to sort of build that brand up?
Yeah, I've been asked this question a lot, and I've tried to come up with scenarios where the brand would recover and people would love the brand like they used to in the past. And I do think that it's possible because people's memories obviously, aren't that long, and in a year, they might forget and, say, hey, this Tesla's a great car and I want to buy it because it's still one of the best vehicles on the road. So it would take a lot of effort from Elon and Tesla to repair those wounds and really kind of like, how would I say, make amends with its core customer base. But I think what needs to be done isn't something Elon's going to do, which involves sort of a mea culpa and maybe some sort of apology to its core users. But I just don't see that happening, or him changing his behavior or his opinions or tweeting less. So I think it's going to be really hard for Tesla to repair the brand.
Hey, Ross, we have like 40 seconds left. Should Tesla still be considered in the Mag 7 or should it be the Mag 6 now?
I think it should be replaced by like Netflix or something. Tesla is a very different company than the other, Mag 7. So, mostly because of the valuation and its lack of growing earnings, I just don't think it deserves to be in that group. When you look at a company like Microsoft, which is just like a monster, just killing it on every front, like what a great quarter for Microsoft. So I don't know. I mean, Tesla's one of the core, technology innovation companies in the United States and the world. And so it deserves a place somewhere, but I just don't know if it's Mag 7 anymore.
Good stuff. Hey, Ross, really appreciate it. Ross Gerber, co-founder, president, and CEO of Gerber Kawasaki Wealth and Investment Management. Speaking of Netflix, record high. It's had a monster run. I mean, think of it. It's not discretionary anymore.
I know, and I was kind of going through it as we were kind of trying to count up the stocks that were performed well since the start of the year, and I was surprised to see that basically is in the top 5.
It's like Walmart and Netflix, right?
Rally, yeah, recession-proof. At least that's what some people seem to think.
I know. Look at that. Who would have thunk that from Netflix? All right, we're going to take you to the closing bell here. 15 minutes away. Then we get Amazon, we get Apple, and a slew of other earnings. Meb Faber is a chief investment officer at Cambria Investment Management. He'll be joining us right after this. This is Bloomberg.
globalization, free trade, and world peace does not really work to the benefit of the U.S. if it loses its technological advantage, because then it becomes like any other country.
Maria Vassalou over at the Pictet Research Institute kicked us off to the close just about 50 minutes ago. Alex, of course, she's much more long-term, thinking about some of those broad themes in the market right now that might actually be that bridge through whatever uncertainties we're in today.
But nevertheless, another big theme is technology and the outperformance of technology today. I mean, I'm even looking at, say, Apple into the earnings. It's underperforming the rest of the Mag 7, but still up 0.6%. But look at this move by Microsoft, Romaine. This is the best post-earnings performance from Microsoft since April of 2015.
Yeah, and I mean, if you read through that earnings report, I mean, you understand why the stock's up, particularly on a relative basis, because again, you get to this idea of which companies really offer genuine value, right? I mean, I know we look at some of these tech multiples, they're still elevated, but when you have a company like Microsoft that generates that type of cash in this environment, I guess that constitutes value.
I mean, to be fair, I think hedge funds were particularly short Microsoft, for example, going into the print, but nonetheless, yes, the facts matter. Well,
we're going to get a little bit, maybe a potential reset after the bell when we get from Apple and Amazon, as well as some of the smaller companies in there as well. But I don't know. I thought it was encouraging.
Yeah,
you're encouraged?
Yeah, let's see what AWS does.
All right, well, let's see what our next guest thinks about it. Meb Faber joins us right now. He's the Chief Investment Officer over at Cambria Investment as we count you down to the close here with about 8 minutes to go. And Meb, I do kind of want to start on this idea of value, because when you start to look at market performance over the past 3 months, let's just say, with all the volatility, all the chaos coming out of Washington, it was very clear where money was being reallocated. People were looking for safety. They were looking for dividend stocks. They were looking for low vol stocks as well. And of course, just pure value plays. Were they to be found?
You know, we've been tracking global valuations across all the stock markets in the world for over a decade. And the U.S. for a long time, has been the jewel of the world. It's outperformed just about everything. And that often leads the P and the PE going up. And at the end of the year, you could argue is probably the second most expensive the U.S. stock market's ever been, with the exception of my favorite bubble, the late 90s. So not a lot of value to be found in those big market cap names. But if you looked around the rest of the world, so we had out of 45 countries, for the first time that we've been tracking this over the last decade, the U.S. was the most expensive country in the world across all the metrics. India, Denmark were up there, but the rest of the world looked pretty great. Average valuations to cheap to screaming cheap. And what's funny about this year, you guys remember the old great Peter Bernstein, the author, wrote a lot of books. He's got a quote that's really stuck out to me a lot this year. And he was talking about asset allocation. And most people, when they think about it, they think of risk reduction. When the stock market's going down, how do you make the portfolio safer? And he said, I view diversification not only as a survival strategy, but as an aggressive strategy, because the next windfall may come from a surprising place. And that's what's happening this year.
Well, that was my next question. I mean, that does appear to be what's happening, or at least the contours of that seem to be taking shape. And obviously, of course, the multi-billion-dollar question, or even trillion-dollar question, Meb, is who does that actually benefit? Is this a story about China? Is this a story about the global South? Is this a story about Europe? Or is it just going to be a revert to the mean with the United States again?
A lot of people love to bucket the foreign markets into foreign developed, foreign emerging, maybe regional markets. But what it's really a story about is the really cheap stuff. And so what do I mean by that? The long forgotten countries, they've underperformed for so long. Many of these have single digit PE ratios, and the performance of some of these countries this year. I mean, look, we run a global deep value fund. This is the GVAL ETF. So I know that thing has stunk it up relative to the S&P forever, but it owns countries like Brazil, or owns countries like Poland, a lot of Eastern Europe, like Czech Republic, all these type of countries that no one wants to buy, or at least not tell anyone they own, and places like China, right? But if you look at a lot of these charts, these countries have gone nowhere for 10 years, 20 years. China at one point before its big run was 30 years of no stock market returns, but that sets the stage for the next great bull market. This basket of stocks is outperforming the S&P by like 25, 30 percentage points this year. So going back to Bernstein, when he talks about these windfalls, these things can happen quick and in a big way.
What's a nice safety trade right now, Meb? How do you think about it?
Hi, is there anything ever safe?
No, but
so to
give me something.
To me, this story has always been one of the U.S. stock market being expensive. Everyone talks about that. Everyone knows that, right? The bigger curiosity to me for a while has been, we did a paper called The Safest Asset in the World, right? You're not trying to make money. You just want to protect it. Everyone assumes it's T-bills. And T-bills are safe on a nominal basis, but not real basis after inflation. After inflation, T-bills have declined by over half. So what you can do actually safer across volatility drawn out is a globally diversified portfolio. So global stocks, global bonds, global real assets. It may not feel like this. And I said it on Twitter, and I got ratioed for this. I said when one of these big down market days, I said for a diversified investor today, like most days, is a snoozer. And so if you have a globally diversified portfolio, particularly after inflation, it's a lot safer than something like what people presume to be T-bills.
Is there something that doesn't work in diversification? That might be a weird question, but like, where's the biggest risk profile you see?
So we did another paper, written a lot of papers nobody's read, but this was on what happens in the worst months for stocks, right? So we were talking about the black swans, what helps? Well, everything you wouldn't expect to help. So foreign stocks don't help if U.S. stocks go down 10, 20, 50%. REITs don't help. Often they're worse. Bonds help on average, but not always. And gold is like your crazy cousin Eddie, shows up at Thanksgiving. You don't know who you're going to get, right? Sometimes it helps in a big way. Sometimes it doesn't. And that's the thing about correlations. You can never count on them. Strategies like value, like Roman mentioned, trend following help on average. And of course, things like buying puts helps, but that's a cost in most other times, much like an insurance. So you try to put enough of these things together into a portfolio so they help on average and over time, and it makes the path much, much smoother.
All right, Meb, great stuff, man. We're going to have to leave it there as we get closer to the bells. Meb Faber is the Chief Investment Officer over at Cambria Investments here on a Thursday afternoon where we had a pretty decent rally, an extension, of course, of that 7-day S&P rally, now an 8th day, and much more stronger gains that we saw today in the NASDAQ indices, though a little bit of selling into the close.
Yeah, we are rolling over a bit around the lows of the session. Again, we're still up 0.7 for the S&P, but we seem to have a little bit of selling as we get into those numbers after the bell.
And we should point out, we get quite a few numbers, at least 20 companies in the S&P 500. When you broaden that out to include the Russell 1000, 1,000 largest companies, we're going to get something like 60 companies reporting, but of course, really only 2 are going to matter. And
and what are they again?
Apple and another one that you might have heard of.
Oh, Amazon.
Oh, Amazon.
Amazon. Gonna love that too. I mean, at the end of the day, how's the consumer doing is key for that company.
You're going to get full market coverage of all of those results with our global simulcast, a simulcast that starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele. We're taking you through that closing bell with a global simulcast. It's already started. Scarlet Foo's already here. Carol Masters there as well.
Was she wheeled in?
Too. No, she actually walked in today. Believe it or not,
I used my
Carol
legs.
Master. You know, she does have legs, Colonel Dan. All right, welcome to our audiences across all of our Bloomberg platforms. Here on a very, very busy afternoon, Carol Master, we get a slew of earnings after the bell, including from the granddaddy, Apple.
Yeah, and I'm looking at stocks selling into the close here. We're still green across the screen, but we're moving down towards our lows of the session. Amazon, Tim, up about 3% ahead of earnings. Apple, it's been pretty little changed. Yeah, it's just up about 1/3 of 1%.
I'd said yesterday was one of the busiest days for S&P 500 companies. Today is actually the busiest. 62 companies worth a combined $9 trillion in market value. We've heard from some of them, but Amazon and Apple are the ones that we are focusing on in the next few minutes.
And it feels like after this, it's kind of, after the climax, we'll get NVIDIA in the coming weeks, but from here on out, it's really about listening for any kind of progress on trade deals. By the way, the Magnificent 7 and the NASDAQ 100 are now above their levels pre-Liberation Day. The S&P 500 getting ever so closer to wiping out those losses.
Just re-tripping when it comes to all of April. But guys, how much of this is short covering mechanical buying versus fundamental buying? And I wonder if we'll get any clarity on that after we open tomorrow.
Yeah, I am curious, though, about the earnings, particularly out of Amazon and Apple. We talk about everything that's gone on with the trade wars here. 2 companies really at the center of that. And, of course, also 2 companies that have shown resilience through past economic travails. It's an 8th day of gains for the S&P 500 off the highs of the day, but a close, it looks like right around that 5,600 level as we wait for these numbers to settle. That's a gain of more than 30 points or 0.6%. The Dow Jones Industrial Average higher by 74 points or 0.2%. The NASDAQ Composite is out front on the back of those big results out of Microsoft and Meta, a gain of about 264 points or 1.5%. The Russell 2000 lagging slightly here on the day, up, but only about 0.6% on the
All
day.
right, quick check on the S&P 500, about 208 names to the upside in today's trade, 293 to the downside, guys, 2 unchanged.
All right, a quick look here at the IMAP. All the sectors related to big tech, infotech, communication services, consumer discretionary, they're leading the gains, each up by at least 1%. In terms of the weak segments of the market, you've got healthcare, of course, a clear defensive sector, down 2.8%, consumer staples and materials, each down about 0.5 to 0.75%.
Well, just a quick check on yields as well. We saw selling pretty much all across the curve and the front end in particular. And the big question was why? And no one seemed to know why. I talked to Ira Jersey, Bloomberg Intelligence is like, I don't know. The ISM manufacturing wasn't great, but it was a little better than estimated. So maybe it was that. Guys, Amazon's out.
All right, let's get to Amazon. That's crossing the wire right now. The company basically saying that in its most recent quarter, it did see net sales. I'm going to start with the bottom line here. So operating margins coming in at about 11.8%. That does appear to be a beat. EPS on the bottom line also appears to beat at $1.59. The street was looking for $1.36. Sales coming in at $156 billion, roughly in line with estimates. Here is your forecast. The company says that for the second quarter, it does expect to see net sales in a range of $159 to $164 billion. The street on average was looking for about $161. So the bottom end of that forecast is below what the street was looking for. Similar story on operating income, and the guidance on the EPS side, also a similar story as well. The company saying that it sees an impact of about 10 basis points from FX, given some of the moves in the dollar as well. Those are the headline numbers here. You see the knee-jerk reaction, guys, down about 3.6%.
Yeah, the second quarter operating income coming from between $13 billion to $17.5 billion, when the estimate was for $17.82 billion. That was a huge miss there. A lot of questions are going to come up about who exactly is absorbing the higher costs of what is coming from China in these goods that are sold to consumers, especially in the wake of what happened earlier this week with the back and forth between Amazon and the White House after that Punchbowl News report. But I think a lot of questions about tariffs on this call.
Yeah, absolutely. And I was just kind of doing a quick look through the press release. I don't see really any commentary so far on it, but it's going to be about that, right? In terms of their costs and certainly what they're seeing with consumers, maybe in terms of buying ahead of it or what kind of slowdowns they might be seeing already.
And that's so interesting, given that so many people are saying that this is kind of the poster child for a company that's really hit by the tariffs in so many different ways. Yet you look at the commentary in the press release from Andy Jassy talking about being pleased with the start to 2025, citing all the different things that they're working on, Alexa Plus, the new Titanium 2, Tranium 2 chips, Prime members expecting speed delivery records. It's as if it's any other quarter when we all know that there's so much in the balance.
Well, that's what was so interesting about what they said about tariffs. It was mentioned once in the press release, and it says, our results are inherently unpredictable and may be materially affected by many factors. They talk about the FX rate, changes in global economic and geopolitical conditions, tariff, trade policies, consumer demand, and spending, including the impact of recession fears as well as inflation. I mean, take that for what it is. Like, you have an outlook, but that's a material set of risks.
But that's like fine print at the bottom, right, about the financial guidance. And I'm wondering if that's any different than it would be 3 months ago.
Yeah, that's exactly like kind of the kitchen sink there of everything that could impact.
But what are analysts interested in, and what are we interested in? That's what's going to be asked on the call later.
And they're going to be asked, and I think the two things coming into this that we had talked to a lot of people about was that we know we're going to see a hit with regards to the e-commerce side of the business at some point in the future. The idea is AWS and some of the other services that they sell, can that hold up? So when you look at the growth of AWS in the most recent quarter, 17% growth, that's great. It was in line with estimates, though it's not materially different than what they had in the year ago period. Similar story for some of their other units here. You're not seeing an acceleration in that growth coming into this environment, so that's going to raise a lot of questions as to what these numbers look like for Q2 and beyond.
All right, guys, just to kind of recap, because we are seeing shares of Amazon down, kind of deep selling, almost 5% here in the aftermarket. So staying near the lows in the after hours. Again, the key line sees second quarter operating income $13 billion to $17.5 billion. Quite a gap there. Estimate on the street was at $17.82 billion. And again, as Romaine mentioned, Amazon guidance sees impact of about 10 basis points from FX. But we really want the commentary and what they are going to say about the retail business, really important in terms of tariffs, because it's been an interesting week already in terms of speculation about the impact for Amazon.
And just in terms of the outlook here, just to put a more fine line under it, the second quarter net sales number will be $159 billion to $164 billion. Analysts were looking for, on average, $161.42 billion. I bring up the top line here because a couple of analysts have said that you really want to look at the top line. It's a pure read on what kind of issues the company faces, as opposed to the bottom line, where you can, decide to factor in different things, and you can figure out how you want to do accounting with expenses, with R&D. So you can tweak that as you want to, essentially.
Right. Let's get to some other earnings. Several crossing the wire right now. Airbnb shares down about 3%. They are mentioning tariffs. They are actually lowering their guidance and making it clear here that there are some challenges ahead. They're giving a weak outlook, basically saying that growth for the main metric that basically tracks nights in experience, that's expected to moderate from the 7.9 number that they had in the first quarter. They did not actually say what that new number would be, basically just moderation from the first quarter. And they've made it clear that they've seen relatively softer results in the past few weeks, and they expect that to continue in the weeks ahead.
All right, guys, just want to hit Instacart for a moment, because the first quarter appeared to do fairly well, and then we'll get to the outlook in a moment. So first quarter revenue, $897 million. That beat estimates. A gross transaction value, that's the key metric for them, is $9.12 billion. That wound up beating estimates. Looking at the outlook, that same number, that gross transaction value for the second quarter, looking anywhere from $8.85 to $9 billion. Orders for the first quarter coming up. Pretty rosy outlooks, guys. Best order growth for this company since 2022.
All right, Instacart to the upside, not the case for Block. It is dropping like a rock, down about 10% here in the after hours. It's down more than 30% year to date. The company cut its adjusted operating income guidance for the full year. The guidance missing the average analyst estimate. Here's the numbers. For the year, adjusted operating income of $1.9 billion. It had seen $2.1 billion. The estimates for $2.13 billion. Company sees gross profit of $9.96 billion. The estimates above that at almost $10.2 billion, and sees adjusted operating margin of 19%, had seen 21%. Again, continue to see Block down about 10% in the aftermarket.
All right, and let's just take a look at Reddit. The stock is surging in after-hours trade after its second quarter revenue forecast topped analyst estimates. But if you look at the quarter that ended, that was a huge beat as well. Just to give you an idea, the average revenue per user, $3.63. Analysts were looking for $3.44. For this quarter, the second quarter, it is saying that it sees revenue from $410 to $430 million. Analysts were looking for just somewhere in the neighborhood of $393 million. So that gives you a sense of the scope of the beat here. And again, Reddit surging right now after posting this big beat.
I'm looking at Atlassian, shares of Atlassian, ticker TEAM, down close to 15% at this point. Fourth quarter adjusted operating margin came in just shy of estimates at 22%. Fourth quarter adjusted gross margin coming in above estimates at 84.5%. The company's shares are falling post-market. Fourth quarter cloud revenue year over year up about 23%. Third quarter revenue for the most recent quarter up $1.36 billion, just above estimates of $1.35 billion. Shares continue to move lower, down 16.8%.
Roku also out with earnings. The shares had been higher. They've been oscillating between gains and losses. First quarter revenue did rise 16% in the quarter to about $1.02 billion. That matches the average of analyst estimates. Bottom line numbers also match the average of analyst estimates. However, the company did say going forward for the second quarter that its revenue might come in a little bit light. It's projecting revenue for the quarter of $1.07 billion, just a touch below what the street was looking for. It also gave gross profit guidance of $465 million, also a touch light from what the street was looking for, and adjusted EBITDA, Scarlett, of $70 million, or Carol, which is also a touch light from what the street was looking for.
All right, a lot of earnings. Just just to recap, Amazon continuing to be down more than 4% here in the after hours. Again, seeing the second quarter operating income $13 billion to $17.5 billion. Estimate on the street is $17.82 billion. A lot of earnings, folks. All right, that's a wrap. Across platform, radio, TV, YouTube, Bloomberg Originals. We know, Alex, you're heading out. Scarlett and Romain, of course, continuing out there on Bloomberg Television, and Tim and I continuing right here on Bloomberg Business Week Daily. Thanks, guys.
And our coverage continues here on Bloomberg Television. Dozens of companies reporting after the bell just now. Reddit and Instacart, two of the big gainers in the after-hours trade to the downside. Atlassian leading the charge, Block down about 13%, and Amazon down 4%. Amazon just reporting, and they actually did report growth in sales, 8.6% to about $156 billion. They also reported improvement when it comes to the bottom line, but the company did give a forecast creating some degree of concern. The company saying that they see operating income in a very wide range of $13 to $17.5 billion. The top end of that range is below the average of analyst estimates. Scott Devitt joining us right now, equity research analyst at Wedbush. Scott, and we should point out, he's got an outperform rating on the stock here. Overall, not bad here. Obviously, we're much more focused on the guidance here. A pretty wide guidance that they're giving when it comes to the operating income range and even on the sales side here. Are you concerned at all about them hitting these targets?
No, I mean, I think we need to slow down a little bit. The rapidity of these earnings makes you get an itchy trigger finger. But I think that Amazon traditionally gives wide ranges for operating income. In fact, last quarter, the range that the company gave was 14 to 18 billion, and the company did above the high end of the range. So when you look at the guide that was given for 2Q, it's very consistent with the way that the company does guide. And the company has a history in the recent past of exceeding the high end of guidance. That's been the trajectory that the business is on. So if you take that into perspective and you look at the 2Q guide, the high end of the guide is roughly around where consensus is. I think the reason why the stock is down, you've had these significant moves up and down in stocks in the last 1 and 2 months. And you get to the point where a company has to beat expectations. And when you look at Amazon's KPIs, the company was in line across the board. And this is a day after Microsoft just kind of crushed the cloud business. Yeah. AWS was in line. So it's like an in-line number. There's nothing bad here. And the guide, I would argue, is actually constructive in this environment. Yeah. But they needed to beat for the stock to go up.
We'll talk a little bit about AWS, at least on the sales basis, 17% growth, still the fastest growing part, at least of the major segments, the fastest growing part of the business. And I am curious, Scott, as to whether there should be any concern about it just being in line, or whether that investors can count on continued consistency in some of the performance that we've seen in the past quarters out of AWS.
Well, investors always like to compare Amazon to Google's business on the cloud side and Microsoft. So when you do that in the quarter, Microsoft won. Every 3 months are a little bit different. There's different products that customers are buying and the companies are optimizing in that 3-month window. So Amazon wins some, Microsoft wins one. This is a win for Microsoft in the 3-month window. I think Amazon, the trajectory of the business, the AI infusion in AWS is going to allow the company to grow top line for AWS 15 to 20% for still some time. And I think, though, when you're looking at stock moves off of earnings, the Microsoft move made sense yesterday, and just purely on AWS and the strength in Amazon going into the print, and inline print just is not good enough. It doesn't mean there's anything wrong with AWS. It just means they didn't book enough deals to beat the number this quarter.
I want to stick with that AWS forecast. 17% growth for the quarter is, slightly better than what we had gotten or what people were expecting. So pretty much in line. Is that the high water mark? I mean, can we expect that to accelerate, or is it going to stay at these kinds of levels and perhaps slow even further?
So comps get a little bit more difficult as the year progresses, but you have to keep in mind that Amazon is integrating AI features into AWS, which will have an increasing attach rate by customers over time. So the possibility that you get moderate uptick in Amazon's business, as well as kind of demand changes that happen from quarter to quarter. You could have the top line accelerate, towards 20% at some point in the future. But I kind of think of it as a wide band of kind of a 15 to 20% growing business, 30% operating margins, and that the company can grow at that rate with that margin for the foreseeable future. Mm-hmm. When you look at the valuation of that business, and then you layer on the retail business and the advertising business, Amazon in aggregate trades at a discount to Walmart now. I don't know about absolute, but on a relative basis, it doesn't really make any sense when you look at the pieces of Amazon and its peer group, why it trades here.
So, Scott, when Amazon hosts its earnings call, what will it want to talk about? What's the narrative it wants to push, and what will analysts want to hear?
Everybody wants to hear about tariffs. But I think with the guide, it looks like, the tariffs are contained in terms of the effect on the business in terms of revenue and operating. Because as I mentioned, that guide is not a bad guide. They should beat the high end if history is a guide. But they'll want to talk about the implications of tariffs, of course. They are also going to want to talk about AWS and the trajectory of the business and the health of that business. I mean, that to me are the two things that investors are focused on. And then thirdly, in importance would be the advertising business, which is doing just fine, but it's really just a derivative of the retail business.
I am curious, Scott, too, and I know this is going to be a harder question for you to answer, but when we talk about just the geopolitical issues and I guess just the political issues, if we will, I mean, obviously a lot of people were making a lot of commentary about what transpired over the last couple of days with Jeff Bezos and this call that Trump apparently had made to him directly because of concerns that Amazon would be publishing some of the tariff impacts on its customers here. I just do wonder about how these companies and their leaders, for that matter, navigate this. And with the idea that, of course, Bezos technically probably shouldn't have been the guy he called. He should have called Andy Jassy. But nevertheless, these are companies that, for one reason or another, are going to be sort of in the crosshairs if they do anything that I guess doesn't please this administration. How do you navigate that? And how do you model that?
I think the playbook is bow to the king, and it is what it is. Mm-hmm. But as it relates to the fundamentals of the business, I'm not convinced, and Amazon suggested they never had intentions of incorporating, the tariff price impact on the core business. Amazon launched the business to compete with Temu and Shein more directly, and in that business, they were contemplating possibly showing the prices because it's a low-cost model, and it's directly impacted by the tariffs, but they're scrapping that, and they had never actually approved it. So it's one of these stories that's not actually factually accurate in terms of the way it was suggested that Amazon was contemplating it, and then the politicians took it and ran with it. And that was it seems like total nonsense relative to what Amazon was actually planning or not planning to do.
All right, Scott, we've got to leave it there. We'll let you get back to work. Of course, we're still waiting on that conference call, which is scheduled.
But these are the times we live in, and it's another, 3.
And all right, that's Scott Devitt there over at Wedbush here. Stick with us. A lot more coming up here on the program. A deeper dive into Amazon, and we're still awaiting, of course, those results out of Apple, which should be crossing the wire in minutes. We're going to talk to Professor Aswath Damodaran over at the NYU Stern School of Business and get his take here on tech valuations. This is The Close on Bloomberg.
All right, let's get another check on shares of Amazon, which are falling right now in after-hours trading after the company projected a weaker than expected forecast for operating profit for this quarter. Tariffs and trade policies and the uncertainty that carries is certainly the big reason behind that. Our next guest says that Amazon's earnings report, more than any other company, carries information about the overall economy, including consumer sentiment and tariff-triggered cost escalations. Joining us now with more is Aswath Damodaran. He is professor of finance at the Stern School of Business at NYU. Aswath, when you look at these kinds of numbers from a company as gigantic as Amazon, which gets the bulk of its operating profit from Amazon Web Services as opposed to the retail business, how much can you really read into an operating profit projection when there's this much uncertainty? How much can you divine from the state of about the state of the economy?
Not much from profits, but more from revenues. In fact, I think the most interesting number in the report was that they came in pretty close to expectations in revenues. If you'd seen a drop in revenues, that I think would have been a sign that consumer sentiment is translating into less buying, and that would have been troublesome. So in fact, I would argue that all of the earnings reports that you will see over the next couple of weeks, the focus should be on revenues and less on earnings. In fact, I can't think of a quarter where earnings are less informative about the future than this quarter. I mean, it's been the most tumultuous, volatile quarter of all time. Earnings are going to be all over the place as companies wrestle with how best to deal with what's coming.
Yeah.
But I think the revenues convey the real news here.
Right. The revenues are hard to play around with, whereas with the bottom line, you can make all kinds of changes to how you account for certain expenses. So let's talk a little bit about that, because you say that for tech companies in particular, the way that they report their CapEx, which is in the form of R&D, gives them a lot of leeway, a lot of flexibility in how they want to frame their earnings.
Right. And I think the reality is the earnings for a tech company cannot really directly be compared to the earnings of a manufacturing company, where CapEx is CapEx and operating expense is operating expense. Because we meld the two with tech companies have far more discretion, power to manage earnings than non-tech companies. So from that perspective, I always view with skepticism both upside and downside when tech companies report earnings, because they don't tell me as much about the future of cash flows and value as they would with a non-tech company. So I think that's something that's got to be factored in when you look at these reports as well.
I'm curious, when we talk about companies and their ability to sustain revenue growth or to continue that growth at a level that's going to sort of please investors, is there a red flag that you can look for in the numbers, in the data, that would maybe give you a sense here of whether things are slowing down? Or is that read, Professor, does that just have to come from more macroeconomic indicators?
I think for the moment, we have to wait for the macroeconomic indicators to kick in, because there are signs that the economy is slowing down. You're going to start to see it in revenues, but it's going to be disparate. I don't think all companies are going to see the same kind of impact. And that's why I think Amazon is such a classic case of a company you can watch, because it sells everything across the board, across all consumers. So it's very difficult for Amazon to shelter itself from an overall economic slowdown. And if I'd seen revenues drop 2 or 3% relative to expectations, that would have been a worrying sign that people are already cutting back on what they're buying.
I am curious, though, when we talk about all the moves that we've seen in big tech, and primarily moves to the downside over the past few months, and this is something that obviously was kind of afoot even before the current administration came to Washington. There was a lot of concerns about high valuations, a lot of concerns that these sort of pie-in-the-sky expectations on AI were just that. Of course, then when we started to see the impact of trade policy and Washington policy, that's when the sell-off accelerated. You're now looking at valuations that, at least in recent history, are relatively low. And I am curious if there is still a case to be made for some of those longer-term structural pie-in-the-sky theses around these stocks that would make current valuations actually look like true value, like valuation.
I'll be quite honest, they're plausible, but investing on what's plausible is a dangerous place to be. So if you're investing in Microsoft because you think somehow the magic of AI is going to double their revenues, I wish you all the luck. It might actually happen, but it's not a sensible way to invest. I think the way to deal with these companies is to invest based on their core businesses. With Microsoft, it remains software and the cloud business. With Amazon, it's retail and the cloud business. With Google, it's online advertising. And then treat AI for the moment as icing on the cake if it comes, rather than building it all up front and paying a hefty premium up front.
I want to look ahead to Apple for a moment here, because one thing that you notice that people are overestimating the long-term impact of tariffs and underestimating Apple's adaptability. When you say that, Professor, what are you referring to? Are you referring to the company's financial flexibility or its logistics supply chain flexibility?
I think it's got both. Obviously, the $200 billion in cash gives you a lot of financial flexibility. But the operating flexibility is also there. I mean, moving an automobile manufacturing plant from one country to another takes 5, 6, 7, 10 years. Moving a manufacturing of smartphones from one country to another, it's an exercise, a logistical exercise, but it can be accomplished sooner than for a manufacturing company. I'm convinced that the need for adaptability is going to actually make some of these Mag 7 companies more powerful going forward because they're extremely adaptable. They can move things sooner than you think they can. I saw this morning an article about Apple and how its value could be halved because of the China tariffs. I think that's the kind of overreaction to what this will do to Apple that I think will make it a buying opportunity if, in fact, the price does drop.
You mentioned, of course, $200 billion in cash gives it a lot of financial flexibility. What can Apple do in this moment, aside from doing things like moving parts of its iPhone supply chain away from China, to really capitalize on this moment and use its cash as an advantage and, perhaps grow parts of its business, grow its footprint?
What set Apple apart from the rest of the world is how cautiously they've approached the world for the last decade. They haven't made big acquisitions with AI, didn't jump in with both feet. And in many ways, that served them well. And I think, you're not going to be able to change the way a company operates. And I think Tim Cook's style is deliberative and slow. And I think it stayed deliberative and slow. So I don't think you're going to see Apple do anything rash just because they feel they have to do something and they have $200 billion in cash. Yeah. And I think that's the right thing to do for the company.
I am curious, Professor. I mean, this isn't just academic for you. You have made it clear that you're an investor in a lot of these names, a lot of these Mag 7 names, with, I believe, maybe the exception of Tesla. I am curious, beyond just the fundamentals here. I mean, you mentioned kind of Tim Cook. I'm curious what your thoughts are on leadership, because at the end of the day, a lot of what's going to happen over the next few months and quarters potentially is going to be much more about managing Washington and managing geopolitics rather than just focusing on selling more products and managing the bottom line.
Hey, you need steadiness at the top. And I think that, as I said with Apple, the fact that Tim Cook is a steady hand at the top does give some confidence to investors in the company. And I think the key thing to remember is even if you believe these companies are significantly overvalued at the moment, and that's perfectly reasonable to conclude, there will be a time when these companies are going to be buys. And these are not companies you want to keep out of your portfolio in the long term. If you get a chance to buy it and the price drops enough, I would invest in them. Because not only are they cash machines in many ways, they're run by people who I think have shown the capacity to adapt to whatever the outside environment is and make decisions that work out in the long term.
All right, Professor, always a great conversation with you. We'll let you get back to work here as we keep an eye on those earnings out of Amazon and await those earnings out of Apple. We should point out, to the professor's last point, Apple shares down about 15% on a year-to-date basis. Maybe that's a potential buying opportunity, but a lot of that's going to depend about what we learned over the next few minutes. Caroline Hyde joins us right now. She is the co-host of Bloomberg Technology. And before we get to those Apple earnings, I have to ask you about Amazon, a negative earnings reaction to really an inline quarter, some concerns about the forecast maybe not being bullish enough.
I mean, a lovely fiscal first quarter if you think about operating margin beating, if you think about sales beating, if you think about AWS, once again, you're seeing slowing growth, but in line with expectations. But the forward-looking guidance, I mean, are you surprised that Amazon is in any way saying we might reduce profitability to suck up some margin hit? I'm not. Time and time again, Amazon delivers on sales, but is willing to swallow tougher profitability for investors more broadly because they always think reinvest in the business, keep on scaling. They're talking about the innovation, whether it's satellites, whether it's AI, but they are going to see increased costs, whether it's your AI infrastructure, like we've seen Signal with Meta, whether it's your third-party sellers, in some way passing on a margin hit to those, most based in China, but they too are likely going to have to in some way suck up a margin hit. They're going to keep consumers coming to the e-commerce side of the business. But many perhaps wanted to see just an outperformance and a feeling that the inventory management had managed to offset some of that margin hit, at least for the first few weeks.
Okay, we have Apple earnings just crossing the wire right now, and this is for the fiscal second quarter. Let's go to the revenue number. Meeting analyst estimates $95.36 billion. Analysts were looking for $94.6 billion, so just slightly higher there. EPS of $165 versus $162. In terms of the greater China revenue for the period, $16 billion. Analysts were looking for $16.83 billion. So that is a miss there. Apple also raising its dividend, which is what it expected to do, and also authorized an additional $100 billion in its share buyback, up to $100 billion. So there's a lot of questions remain about the use of cash. The iPhone revenue for the period, for the second quarter, $46.8 billion. Analysts were looking for $45.94 billion. And it goes to that idea that people were trying to front run the tariffs by buying up iPhones.
Yeah, going back to those those expenses, though. We talk about expenses going up. I thought it's also interesting, too, to see cash and cash equivalents going down about 14% year over year, down to about $32.73 billion, only $32.73 billion. A chuckle at that, but it gets to this idea as to where the next investments are coming in. Services revenue did actually surprise slightly to the upside, a 12% gain here. And overall, we talk about gross margins holding at similar percentages as what they were last time. Caroline Hyde still with us here, the co-host of Bloomberg Technology. And on the surface, Caroline, I mean, the numbers look decent. Of course, the big question is, what are these numbers going to look like over the next couple of quarters?
What is the forward-looking guidance? And they never really give it in the press release. We have to wait for what's said on the call. But more broadly, there is a slight weakness still in China, I think, in terms of their fiscal second quarter sales. And we did see perhaps that pull forward, that inventory. Maybe not that much more, 46.8 billion versus 45.9 billion was the expectation. But I think this is a company that's still trying to say, look, we're steadying it for you. We're giving you money back. We're going to be buying back stock. We're going to be giving you a dividend. But ultimately, we want to get devil in the detail. Also, they say we welcome the 16E, of course, the slightly lower end phone, which had a lower price point. But remember, had most of the tech that the iPhone 16 had more broadly. What does that mean to any cannibalization and what phone people are actually buying at the moment?
It's worth noting here that iPhone revenue, even though it did top analyst estimates of $46.84 billion versus the consensus estimate of just under $46 billion, was only a 1.9% increase from last year. So that goes to show that even with a lot of people rushing to go buy iPhones, you're not seeing a lot of growth here in this one product.
And I think that's what people are worrying about from the AI side of the equation, because why were you going to be upgrading at this particular moment? iPhones last longer, they're ever more powerful, we therefore wait longer. And many felt, okay, AI, the Gen AI offering is going to be where it's at. But Siri has failed to impress many. We feel that they're behind the curve in that sort of element. And so it didn't just catalyze the desire to go and upgrade ahead of an iPhone 17, for example. We all want to kind of understand where the services side of the business goes as well, because that is the power of Apple. That is the ecosystem. And that is why the CFO in the note says, of course, think about the amount of devices that are in people's hands now. Well, they're currently talking about second quarter service revenue actually kind of meeting expectations more broadly. But what does that look like in the forward-looking guidance? Can they increase prices, or perhaps people stall on actually upgrading their phone?
All right, Bloomberg's Caroline Hyde, co-host of Bloomberg Technology. Thank you so much for the instant reaction here to Apple's latest results. We want to get more insight and bring in Gil Luria, head of technology research at D.A. Davidson. Gil, in looking at these numbers, we're going to focus here on the iPhone, $46.8 billion in revenue for the fiscal second quarter, and as we're looking for just under $46 billion. So that is a beat. What are your questions here in terms of how Apple positions itself going forward in not just this quarter, but the quarters to come, and whether it can keep this up?
Yeah, that's the really big question. All we learned from this earnings report so far is that they're going into the more challenging period doing okay. The iPhone is growing mid-single digits. Services are growing low double digits. They were able to maintain profitability. The world has changed since that quarter, and now what we're going to want to hear from the management team is how are they going to navigate? What are the additional costs? How much are tariffs going to impact? How much is that going to flow through pricing? How much are they going to absorb through lower margins? How much are they going to push down to their suppliers? What are the logistical changes that they're going to make? How quickly can they move their production from China to India? Those are the really big questions. This quarter is fine. It could have been worse. It's fine. The really big question is, how is Apple going to adapt?
Okay, so that's a long list of questions. How many of those questions do you reasonably expect to get any kind of insight into during this earnings call?
I think they can give us a lot of those answers, at least in the 1 quarter period. They can tell us how much is this going to impact iPhone results next quarter. How much are they going to absorb? I think those we can get. Then we will be able to get some longer term answers about what they can do in their supply chain. Again, the big question there is how quickly can you move production out of China to countries that are going to have lower tariffs? Because we are looking like we're going into a world where we have low tariffs with most countries, high tariffs with China.
Do you think there's a way, though, that they could thread that needle, Gil? And we had a guest on prior to you, Professor Aswath Damodaran, who kind of referenced that New York Times story that I'm sure you saw that kind of talked about this idea that if Apple somehow it completely divorced itself from China, it would be basically disastrous for them, certainly in the short term. And I know that's sort of an extreme hypothetical scenario. But so far, Tim Cook has done a pretty good job at sort of navigating geopolitics. We saw that during the first Trump term a few years back. We saw that during the pandemic. And at least in this first 3 months, it appears that he's trying to find a way to navigate this again.
Yeah, I really appreciate what Professor Damodaran said, especially about Apple's resilience, because what we're talking about here is a multi-quarter transition, maybe even a multi-month transition. In the 3 to 5 year time frame, Apple will have optimized its production again, will sell a lot more devices, will sell a lot more services. Part of the reason investors have come back to Apple and it looks more defensive than you would think as a consumer company is the fact that we can look past that and have faith in the management team that they will be able to adapt to these changes. There will be some production in China because China is still a big market for them, but they will need to still move. And they're likely to move production out of China, even if we do get a somewhat reasonable resolution with China. Mr. Cook has done a good job navigating both administrations so far. If he continues to do that, Apple should be able to evolve. This is going to be a tough year, though.
I am curious. Let's look a little bit longer term here. There's been a lot of talk about new products. The idea that Apple is still just kind of, feasting off the success of the iPhone and to maybe a smaller extent the iPad and the watch. I know they tried to make a splash with the headset, which clearly did not get the traction that they had thought. Do they need that sort of next big thing, or can they continue kind of milking this ecosystem that they've built over the last few decades with the iPhone?
So the current growth rates on the hardware plus the double-digit growth in services can probably support low single to mid-single digit growth for Apple. But they do have two engines coming online. One is AI, and yes, we are disillusioned at this point in time about AI functionality, but that doesn't mean that by iPhone 17, maybe 18, we start seeing more personal assistance. Agentic technology gets to a point where we can ask the phone to make reservations for us, to book a flight for us. That's not that far away. That will be a driver for Apple. And then even though Vision Pro in itself didn't prove out to be a hit product, the notion that we will be consuming more interactive media and spatial compute on a headset is still likely. The possibility that they introduce glasses the same way Meta has introduced the Ray-Ban glasses is likely. So in the 2, 3, 5 year time frame, Apple does have the innovation pipeline to drive faster growth than that.
All right, Gil, we'll let you get back to work. I know you're busy. Gil Luria, head of technology research over at D.A. Davidson, as we take a closer look at those results out of Apple. Growth on the sales side, but some concerns here about what those numbers are going to look like going forward. Specifically, when it comes to the iPhone itself, we're talking about $47 billion in revenue. That is a slight bump from what we saw in the year ago quarter. But now, and that has been the support for its profitability. Let's bring Nabila Popal into this conversation right now. She's Senior Director of Data and Analytics over at IDC. So overall, the iPhone numbers weren't bad. In fact, in any other year, I think we would probably pat them on the back and say, job well done. Of course, everyone wants to know, what are we going to be looking at when we get the 2Q numbers, the 3Q numbers, and beyond?
Absolutely. And I think everyone said that, right? It's not really about the Q1 results where they had the largest growth year on year from any of the top 5 vendors, but it's really going to be about moving forward. And Apple's got not just the tariff challenges, but multiple challenges ahead, right? Just about navigating. And the story is really going to be, and what we are all going to be looking for in this earnings call just in a couple of minutes, is that how they're going to be clarifying that and really playing the roadmap about showing investors how they plan to navigate all these challenges, about how they plan to move their logistics and supply chain and manufacturing, how they plan to exactly do it. And I know we've heard a lot about moving to India, but everyone knows that this can't be done overnight, right? So what is their roadmap and what is their timeline? So deal with that. And then also with the AI, I know we've heard about their partnership with Google, and we're all hoping that some things will be announced by WWDC. So there's multiple things that need to be addressed, and of course the China piece.
Well, I am curious though too about Apple's competitive position, specifically when it comes to smartphones. I mean, it is decidedly a premium product, if you will, and we're looking at economic times. It could be a little tighter. I would think a lot of people who would be in the market for a new phone might think twice about whether they want to spend $1,000+. I know they have lower priced phones. Even those, as someone who was recently in the market for one, still you're coming in at $500 to $600 unsubsidized at least. Is there a concern here that competition from cheaper models, cheaper brands, could actually eat into their market share?
So, speaking about the U.S. market, which is pretty dominated by Apple and majority share, 50% of the U.S. market is Apple. So the concern really, and the tariffs impact the U.S. market the most at this stage, is that will prices go up, right? At this, and where the tariffs stand right now, will they go up by 20%? And how will Apple address this? Will they pass the prices or the impact of the increased costs to the end consumer? Will they, obviously, we know Apple's strength with the supply chain, that we're hoping that they will work with their supply chain and partners to hopefully, absorb some of that cost. But even if it does get passed on to the end consumer, the way we see the U.S. market, the way it's structured with the financing plans and installments, we don't see it really disrupting the market so much where consumers are suddenly going to be going to the cheaper devices, right? Because the impact of the increased $200, if you spread it over 36 months, since the majority of consumers in the U.S. buy with these financing plans, it's just really going to help cushion that blow.
Okay, so that's in the U.S. market where Apple has the dominant market share, 46% market share in the first quarter of 2024. What about, and 51% in fact in the first quarter of this year, what about overseas, outside the U.S. and in particular China? Is Apple still a premium product in China when Huawei makes phones that cost $3,000 and there's this patriotic nationalism when it comes to buying consumer products in China?
I mean, absolutely. Apple's has been in the leading, top 5 player for a long time. And if you look at the premium market, has been the leading. I know Huawei's gained, a lot of share in the recent quarters. But Apple has been the dominant player in China. And last quarter, it did drop as part of the total market, about like almost 10% share in China. But we do think that as far as Apple's strength, it lies in the premium market, and it's not. We don't see, despite all of this significant talk and a lot of the Chinese players making so much, obviously advancements in AI and a lot of AI features and a lot of marketing in that. And we all know, and what is a fact is the fact that AI is behind in AI. Apple is behind in AI. We don't see that jump of consumers just going to Android devices yet still. So Apple still has some time, at least until AI becomes a driving factor, which we don't see that yet. It still hasn't become a dominant, purchasing decision.
Absolutely. It's certainly a work in progress. Nabila, thank you so much. Nabila Popal is Senior Director of Data and Analytics over at IDC. Of course, these results from Apple as well as Amazon really come at a moment of swirling uncertainty. Trade policy and rising geopolitical tensions are weighing on the overall tech sector. I want to bring in now to discuss the greater tensions between U.S. and China, Ray Wang. He is chairman and founder of Constellation Research. Ray, when we talk about tariffs and the tension between the U.S. and China, I think how Apple kind of sits in the middle there, because the first time around in the first Trump administration, Apple won exemptions from all those China-related tariffs. It wasn't subject to any of that. This time around, it's proving to be a lot more problematic or perhaps sticky, because we know that smartphones and laptops have been exempted, but there might be sectoral tariffs on semiconductors and other specific items. How are you thinking through how the administration might treat Apple as a way to navigate what it wants to accomplish in resetting trade relations with China overall?
It's a great question, right? I mean, Apple's one of the most successful companies, not only manufacturing in China, but also selling in China. And because Apple's a premium product, they've been able to sustain their margins. But now we have a big shift, right? Manufacturing moving to India, manufacturing moving to Vietnam is not enough given the current tariff situation. And so there's an economic decision that has to be made. Do I take the 10% tariffs or whatever number it's going to be and continue manufacturing outside of the U.S., or do I move precision manufacturing into the U.S. and start shifting those supply chains? The reality, that's not a 12-month decision or 24-month decision. That takes 36 months to get that full supply chain up and running. And I think over time, what you're going to find out is the administration is going to understand that as well. And through negotiations, they're going to create some kind of transition plan so that we get precision manufacturing back in the U.S. That's really the best outcome. The worst outcome is airlifts out of India, continuing paying some tariffs, increase in prices. So I think it's going to happen somewhere in between. But they've done a very good job navigating this. And Tim Cook's been quite the statesman.
Right. And thank you for laying out the different paths you see going forward here. Your take on the big picture when it comes to tariffs is that this is the White House's preferred tool to reset global trade, especially with China. And the tariffs are a way to bring trading partners to the table and ask them essentially to choose sides. When you say that, are you referring to choosing between Team USA and Team China, making it, a bifurcation?
Scarlett, you're absolutely right. What's actually happening is tariffs were, hey, you want access to $29 trillion in the marketplace? Well, you're going to have to pay for access. Or you can build everything in the U.S. and not pay for any access. And I think that's the ultimatum. Now, the results are going to be different, right? But you set an ultimatum to get everyone to the table. If they hadn't done that, we wouldn't have had those conversations. But it's part of a bigger set of packages. It's not just about tariffs. It's about what does manufacturing capacity look like in the U.S.? For example, if we can't manufacture the basic pieces in a supply chain in the future at a scale that's important, we won't be able to sustain any kind of national security advantage.
But to that point, though, too, and I don't want to get too deep into the politics of it, but there's been concerns about, I guess, how this has gone about. And it was interesting at the event yesterday at the White House where Jensen Huang and several other business leaders were there. I mean, Jensen actually talked about this idea that, this isn't really about necessarily bringing jobs, meaning meaningful amount of jobs back, because as he put it, a lot of the advancements in technology means that the next generation of manufacturing plants are going to be much more automated and they're going to need much less human involvement. And he kind of was holding that up, not as a criticism, but as fact, as a selling point, that this is sort of the future and that we need to embrace it. Is that being embraced?
I believe that is correct, but I don't think the general public sees it that way. They're like, oh, factories are coming back, and a romantic notion of, jobs coming back and full factories in place. These are robots that are coming back. We're talking about precision manufacturing. Most of these plants will be 50 to 60% automated. There'll be dark factories, dark warehouses, meaning that might not even be a single human in those warehouses going forward. But it's important to understand that we're at a war for a couple things: AI, energy, and manufacturing capacity. If we, for example, were to go into war with China at the moment, they could produce robots and humanoids, probably, let's make up a number at $1,000 a unit. We're 5 times more expensive. That's a very short war. We don't have capacity. Our energy is 10 cents a kilowatt, or theirs is 2 cents a kilowatt. Their manufacturing capacity is 5x of ours at the moment. And when you think about just the ability to do AI and advancements, they're close. Jensen's correct. They're pretty close.
So just one final, we only have about a minute left here, Ray, but I am curious, when we talk about the U.S.-based tech companies that could potentially lead the charge, is that going to include the names that we're talking about today, the Apples, Amazons, or even like the Microsofts of the world, or is it going to be a whole new generation of companies on the come up?
Good question.
That's a great question. We're in the middle of a shift where we're going to see brand new manufacturing companies that are out there. There's some interesting companies like Fictive that's doing this, build to order manufacturing in a digital foundry. You see lots of companies that are going to emerge. We have to build that supply chain and that base to be able to compete in the long run, because we don't have the same capacity China has, and we haven't scaled our energy costs down enough to be able to compete in AI and manufacturing.
All right, Ray, got to leave it there. We're going to have a conversation about AI in just a second. Always appreciate your thoughts here. Always great. Definitely take a listen to him, the founder of Constellation Research. When we come back, we're going to continue our focus on Apple and count down to that earnings call with Tim Cook and a closer look into the company's AI strategy. This is Bloomberg. Apple shares down 2.5% in the after-hours trade as we await to hear from CEO Tim Cook on the earnings conference call that starts in just a few minutes' time. Mark Gurman joins us right now, our man out in Los Angeles who covers everything Apple for us. And I do want to talk a little bit, Mark, about the company's AI strategy. It just seemed, I don't know, it was like 13, 14 months ago. We were talking about the rollout of the Vision Pro. We just had some reporting from you and some other reporters at Bloomberg over the last few days and weeks about a reorganization of its robotics and its Siri unit. What is the artificial intelligence strategy or Apple intelligence strategy? What is that strategy right now?
Yeah, the Apple intelligence strategy is a little bit unique compared to the competition. What Apple has done is they've taken specific AI features and applied it across the system in specific places. So they have features like writing tools. So anywhere you have ways to manipulate text, you're able to take that text, summarize it, bullet point it, make it more professional, make it more conversational. So instead of having a unified chatbot-like experience like you'd get in something like Gemini or ChatGPT, they're trying to place it in as many places across the iOS operating system, macOS operating system as possible. And don't forget, Apple's AI strategy, it expands just beyond the software features. Something like the Vision Pro, it uses a lot of real-time AI to actually process the visuals around you. So there's some pretty highly technical stuff tied to the hardware as well beyond Apple Intelligence. But of course, Apple Intelligence and Siri are the things that most people are focusing on.
Right. And compared with the other big tech companies, Apple is seen as kind of behind the curve when it comes to really deploying AI. Is it behind the curve in terms of spending on AI, in terms of investing in AI capability as well?
I don't think so. I mean, certainly at the get-go, when you saw ChatGPT and Gemini and Copilot and some of these other services roll out, certainly Apple was underinvesting compared to those. But I think that Apple has come to the point of realizing that AI is the future of tomorrow and decades to come, and it's really something that's happening today. And so I think they're reallocating a lot of their R&D and investment budget towards beefing up those AI capabilities. So I definitely think there is a future for Apple and AI. It's just until this point, it hasn't been so great.
Just real quickly here, in terms of their just core business, I mean, we've been talking a lot before you about sales of the iPhone, iPad, and the Mac as well. Is there any sense here that they would put any more attention into the non-iPhone business, meaning like, you know, the iPad and obviously with the Mac itself?
You know, we've been talking about, not we, people have been talking about, certainly not me, the death of the iPhone for a decade now. But the iPhone is going nowhere. For the foreseeable future, that's going to be the hub at the center of the Apple ecosystem, and everything is going to surround that phone. Maybe the shape will change, maybe the screen will change, maybe the way you use the device will change, but the iPhone is going nowhere. Apple can look to make all sorts of new product categories, but nothing's going to change the iPhone from generating half of the company's revenue.
Yeah, and that part has been consistent through the quarters and through the years. Bloomberg's Mark Gurman, thank you so much, our man on the ground covering all things Apple. And with that, Romain, we're looking at Apple shares down about 2.5% after hours trading. Amazon down about 4.4%.
Yeah, and we should point out when we look at broad market futures here, they are lower from where they closed in the cash session. So that could be a big thing. I just want to point out real quickly, you see all the names on your board, but you got Block down 16%, Atlassian down 15%, Ingersoll Rand down 6%, and I guess you do have a couple of bright spots there. It was that Instacart up 5%, and Reddit. You're a big Redditor. What's your handle on Reddit, Scott? You can tell
I'm
the
not
world.
going to tell anyone. Yeah, I don't want to be
trolled. Up 18%. All right, if you're interested in politics, stick around. Joe and Kaylee up next on Balance of Power. This is Bloomberg.